Hello and welcome to another session of the My Solo 401k Financial My Community Daily Webinar Series. Today we're here to discuss the 2025 Solo 401k magic number. How much income needed to max out Solo 401k contributions? As always, we're on YouTube, we're on LinkedIn, we're on StreamYard. If you subscribe or follow us on those platforms, you'll get the notifications of when we go live. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern, back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. So it's always an open session where you can come and ask questions. So please feel free to chat over questions or topics that you wish to discuss. And we'll go through those questions sequentially. But let's get into the topic that we wanted to share today. So if you're finding this helpful, please like on YouTube as it helps to get the word out to other entrepreneurs like you. So we'd like to get this information out to as many as we can. So today's topic, of course, is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. If you subscribe to our channel, you'll get the notifications. For example, we've been doing this deep dive sessions the last couple of Fridays now regarding how much income you need to be able to maximize contributions. Last Friday was geared towards businesses, taxes, and S-Corp. So if you subscribe, you can check the history and see last Friday's session. Today is geared towards businesses that are taxed as a sole proprietorship or a single member LLC. You can also join us 24/7 on our community. It's totally free to join. All are welcome. mysolo401k.net/my-community. We have a wealth of resources there. For example, we have forums. We have over 30,000 members. It's a vibrant community where people are posting questions. It's a great way to just learn and to share the knowledge. Again, we host the webinars twice a day. You can always find the schedule at mysolo401k.net/webinar. We also have the industry's first AI. So it's a great way to learn and get answers to questions quickly and find resources quickly. So to first lay the foundation, a solo 401k is for an owner-only business with no full-time W-2 employees. So think like an independent contractor, a solo practicing attorney, or professional. You don't need to have a separate entity in order to be eligible to set up a solo 401k. We have many customers who operate without a formal legal entity. They operate as a sole proprietor. Of course, it's totally fine if you operate via an LLC or an S-Corp. The key is that you report earned self-employment income on your taxes. So for example, that's going to be on Schedule C for a business that is taxed as a sole proprietor, or W-2 wages, for example, for a business that's taxed as an S-Corp. There's no minimum amount of earned self-employment income that you need to report in order to be eligible. Your spouse or business partner can participate as long as they are also reporting their own earned self-employment income. So for example, as long as they also have a Schedule C from the business or a W-2 from the business, you can have a solo 401k if this is your side hustle, right? If you have a day job, even if you participate in your W-2 employer-sponsored plan, as long as you're reporting some type of self-employment activity with no full-time W-2 employees working for you, you can set up a solo 401k. Now, a top question this time of year is, when is the deadline to make contributions? So for a business that's taxed as a sole proprietor, if you set up a plan last year, if you signed up with us, for example, before the end of last year, or you signed up with somewhere else, like a basic plan at a discount brokerage, then you would have preserved the ability to, and then if you upgrade to our plan, right? So you can make, for example, the mega backdoor Roth contributions. If you had set up a basic plan somewhere else, you could still upgrade to our plan. Or if you signed up with us, you can still make contributions for 2024, all types, all the way up until the business tax return deadline, including any timely filed extension. Now, if you hadn't set up a plan with somebody else, or you didn't sign up with us before the end of last year, and your business is taxed as a sole proprietorship, you can still make contributions for 2024, but it's going to be more limited. So for example, if you want to make employee contributions, you'd have to set up the plan in time to make those employee contributions for 2024 by April 15th. If you want to make employer or voluntary after-tax contributions for 2024, you'd have to set up the plan in time to make the contributions either by April 15th, or if you file a timely extension for your 1040 by October 15th. Now, for all other business types, partnerships, S Corp, C Corp. If you had signed up with us before the end of last year or signed up somewhere else, for example, with the basic plan, and now you want to upgrade to our plan, then you could still make all types of contributions for 2024 because you would have met that December 31st deadline, including employee, employer, and voluntary after tax by the business tax return deadline, including any timely filed extension. So, for example, if your business is taxed as an S Corp and you filed a timely extension to file that 1120S, you'd have until September 15th in that case. Now, if you had not set up a plan, though, either with somewhere else or with us before the end of last year, and your business is not taxed as a sole proprietorship, right? It's taxed as a partnership or an S Corp or a C Corp, then it's too late to set up a plan now in 2025 and make employee contributions, but there's still time to set up a plan potentially in 2025 and make employer and or voluntary after-tax contributions. As long as you do that, as long as you set up the plan in time to make those employer or voluntary after-tax contributions for 2024 by the business tax return deadline, including any timely filed extension. So again, if you had not set up a plan before the end of last year, your business is taxed as an S Corp, but you filed an extension for that 1120S, you could still set up a plan here in 2025 and make either employer or voluntary after-tax contributions for 2024 by that extended tax return deadline, by that September 15th deadline, in other words, if you filed an extension for your 1120S. So now that we knocked out one of those top questions this time of year, let's dig into the topic more of how much income one needs in order to max out solo 401k contributions. Specifically, we're focused on businesses that are taxed as a sole proprietorship, right? In other words, stated another way, right? What's my magic number of income that I need in order to be able to hit my contribution goals? So it's first to lay the foundation with the contribution rules, right? And understand how it's determined how much someone can contribute to the solo 401k. So there are certain factors that will impact how much one can contribute to a solo 401k. One is the self-employment income. The whole purpose of the solo 401k is for someone who's self-employed to be able to save for retirement, right? And the purpose is to be able to save earned self-employment income. So you have to have that earned self-employment income to justify the contribution, right? There's the principle that you can't contribute more than what you earn, right? You can't save more than what you earn. Another factor is your age, right? Once you're over age 50, you can start making catch-up contributions. And now in 2025, if you're between the age of 60 to 63, you can now make what's called a super catch-up contribution. Additional factors would be whether you participate in another retirement plan, like a 401k through your day job. So if you make contributions to your day job plan, that'll reduce the employee contributions that can be made to the solo 401k. And then the last factor is going to be the type of contribution, right? The solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because you can fill up different buckets, right? You're both the employee and the employer. So you can make both employee and employer contributions. In addition, if you have a plan like ours that allows for multiple types of contributions, such as pre-tax, Roth, and or voluntary after-tax, and voluntary after-tax is how one makes mega backdoor Roth contributions, then those are additional types that will impact, okay, how much can I contribute to a solo 401k? So we'll keep that in mind as we go through the topic today. Now let's start to dig into each of those factors, right? So self-employment income. Again, we're focused on businesses that are taxed as a sole proprietorship. Could be an LLC that's a disregarded entity where the income is reported on Schedule C. Could be a 1099 independent contractor. So if that's how your business is taxed, your self-employment income is going to be based on a pre-calculation. In other words, you have to take line 31 of Schedule C. This is where you report your net income, right? After your business expenses. Your net income reported on line 31 of Schedule C less 1/2 of the self-employment tax. Now, you can't consider W-2 wages from other sources like a day job. You can't consider investment income. Remember, the whole purpose is to save earned income. So you can't use investment income like income reported on Schedule E to justify contributions to a solo 401k. So here's a good visual that explains that calculation, that pre-calculation. Line 31 of Schedule C, less 1/2 of the self-employment tax. We have a calculator on our website that will also run this number. Now, you also have to keep in mind the overall limit. For 2024, the overall limit was $69,000 plus an additional $7,500 if you're age 50 or older. For 2025, that limit increased. Right now, it's instead of 69, it's 70. The catch-up contribution that applies for those age 50 or older is still $7,500. But if you're age 60 to 63, instead of $7,500 as a catch-up, there's now a super catch-up contribution limit, which is $11,250. So as we mentioned, right, there's different buckets that you can fill up. So the buckets that you want to fill up will impact how much you can contribute. So for example, the pre-tax employee contribution limit, which is also referred to as a salary deferral, is 100% of your self-employment compensation. Remember, that's line 31 of Schedule C, less 1/2 of the self-employment tax. So once you run that pre-calculation, you can contribute 100% dollar for dollar up to $23,500 for 2025, or $31,000 if you're age 50 or older, or $34,750 if you also factor in that super catch-up if you're age 60 to 63. Now, this employee contribution limit, it will be reduced by contributions made to another plan. Remember, I said one of the factors is whether or not you contribute to another plan, like a day job plan, because this employee limit applies at the employee level. So if you are participating in a 401k plan through your day job and you max out your contributions, say in order to maximize the matching contribution, for example, that you receive, well, that will reduce, and if you max it out, eliminate your ability to make employee contributions to the solo 401k. Now, one exception to that rule that you have to aggregate across all plans that you contribute to is a 457 governmental plan. In other words, contributions to a 457 governmental plan will not reduce how much one can contribute to a solo 401k. So our plan not only allows for pre-tax employee contributions, it also allows for Roth employee contributions. It's going to be that same limit, 100% of self-employment compensation, dollar for dollar, up to $23,500, or an additional $7,500 as a catch-up if you're age 50 or older, or an additional $11,250 as a super catch-up if you're age 60 to 63. If Roth contributions are going to be made to the plan, they need to be deposited into a separate account. So you might have one account for pre-tax contributions, a second account for Roth contributions. Now, the second type, remember we talked about how you got employee and employer, because in the words of the IRS, you're both the employee and the employer. So the employer contribution limit, also known as the profit sharing contribution limit, is 20% of your self-employment compensation. Remember, for a business that's taxed as a sole proprietorship, a 1099 independent contractor, freelancer, etc., self-employment compensation is equal to line 31 of Schedule C, less 1/2 of the self-employment tax. So you have to run that pre-calculation, multiply times 20%, and that's how much can be contributed to the solo 401k as an employer contribution. Now, you still need to keep in mind the overall limit, right? The sum of all the different types of contributions that are made to the solo 401k, whether employee, employer, and or voluntary after tax, cannot exceed the overall limit. $70,000 for 2025, $77,500 if you're age 50 or older, $81,250 if you're age 60 to 63. Now, contrast how with employee contributions, you have to consider all the contributions that the individual contributes to across all the different plans that they make contributions to. With employer contributions, in contrast, the employer contribution limit applies at the plan level. So stated differently, one's ability to make employer contributions is not impacted by contributions made to another plan, like a day job plan. Now, one exception to that rule that you don't have to aggregate contributions made to a day job plan for purposes of determining how much you can contribute to a solo 401k as an employer contribution is the 403B exception. In other words, all contributions made to a 403B, whether employee, employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. Now, Secure Act 2.0, it now allows for Roth employer contributions, in our experience, there's not a lot of people taking advantage of it, at least with our plan. Why is that? Well, our plan already allows for the mega backdoor Roth contributions. It's easier to hit the maximum if you just make mega backdoor Roth contributions. In other words, you don't need as much income, because remember, if you want to make employer contributions even as Roth contributions, it's going to be limited to 20% of your self-employment compensation. So you need 5 times the amount of contribution that you want to make as income to justify that contribution. Whereas the voluntary after-tax contribution limit, as we'll see in a moment, is 100% dollar for dollar of your self-employment compensation. So you don't need as much self-employment income to justify that voluntary after-tax contribution. In addition to that, voluntary after-tax contributions, there's more flexibility. In other words, they can be transferred out of the plan to a Roth IRA. Some individuals want to make an after-tax solo 401k contribution, then transfer the funds out of the plan to a Roth IRA. So because of the because you don't need as much income to justify the contribution, because there's more flexibility with respect to voluntary after-tax contributions. In our experience, most clients would prefer just to make voluntary after-tax contributions as opposed to making employer contributions as Roth contributions. A couple of FAQs for those that do want to make those employer contributions as Roth contributions. They can be deposited into the same account into which the individual is making Roth employee contributions. So in other words, both Roth employee and Roth employer contributions can be deposited into the same account. Again, the limit is going to be 20% of self-employment compensation. As far as reporting, this was an open question for almost a year after Secure Act 2.0 until the IRS answered the question with IRS Notice 2024-2 in terms of how to report those employer contributions. Because keep in mind, historically, employer contributions were always pre-tax contributions, so they were tax deductible. But now that now that the ability was there to make employer contributions as Roth contributions, well, that would necessarily need to be made on an after-tax basis. So there was an open question as far as how to report it. IRS Notice 2024-2 answered that question, where the Roth employer contributions are now reported as tax deductible, so like a pre-tax contribution on the employer's return for the year for which the contribution is made. So it'll still reduce the taxable income on the employer's return, but then it'll become taxable to the employee for the year for which the contribution is deposited via 1099-R. So if the contribution is made for 2024 but deposited in 2025, it's going to reduce the employer's taxable income for a business tax as a sole proprietorship. That means on the 2024 1040, but then it becomes taxable to the employee. So it's added to the income on the 2025 1040 via 1099-R that is issued to report that as taxable income to the employee, in this case, the solo 401k participant. So now that takes us to the voluntary after-tax contribution limits. So those limits are, as we alluded to, 100% of self-employment compensation, dollar for dollar, up to the overall limit. For example, $70,000 for 2025. Stated differently, the lesser of self-employment compensation and the overall limit. Now, you still need to keep in mind the overall limit, right? The sum of any contributions made to the solo 401k could be after tax, could be employee, could be employer. The sum of all those contributions cannot exceed the lesser of self-employment compensation or the overall limit. Another thing that's noteworthy is with regards to catch-up contributions, right? The $7,500 if you're age 50 or older, or $11,250 if you're age 60 to 63. Those contributions are not made as an after-tax contribution. They would be made either as a pre-tax employee or a Roth employee. But for purposes of aggregation, you can ignore that. So at the end of the day, you'd still be able to, for example, contribute up to $81,250 between catch-up and after-tax contributions, assuming you have the self-employment income to justify it. So you still be able to hit those higher limits. The key point to understand is that catch-up contribution is not going to be made as an after-tax. Again, it would either go to the pre-tax employee or the Roth employee. Now, a couple other noteworthy points. So even though a voluntary after-tax contribution is a type of employee contribution, you don't have to aggregate with contributions made to a day job plan. In other words, contributions that you made to a day job 401k plan will not reduce how much can be made as a voluntary after-tax contribution to the solo 401k. Now, the exception to that is that same 403b exception, right? All contributions made to a 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, whether employee, employer, and or voluntary after tax, the sum cannot exceed the overall limit. And then like Roth contributions, how those Roth contributions need to be held in a separate account, likewise after-tax contributions need to be held in a separate account. This is how folks will end up with 3 different accounts, right? Pre-tax, Roth, and after-tax, or 6 accounts. Let's say there's 2 spouses, both working in the same business, both participating in the solo 401k. If each has 3 accounts, pre-tax, Roth, and after-tax, that's going to be a total of 6 accounts. All right, so now that we've laid the foundation, we can start to dig into different scenarios, right? Because what the magic number is going to be different, because maximizing solo 401k plans or contributions means different things to different people. So we want to talk about different scenarios to try to address as many of the scenarios as possible, right? And answering that question of how much income I need in order to be able to max out my solo 401k contributions. So for some individuals, they want to maximize their solo 401k contributions while keeping their self-employment income as low as possible, to the extent that they have the ability to control that. So we're going to assume we've got a self-employed business tax as a sole proprietorship, right? Single member LLC, 1099 independent contractor, freelancer, a solopreneur. So it's one participant, does not make contributions to another plan like a day job plan. They want to contribute 100% of their self-employment compensation. Remember, self-employment compensation is equal to line 31 of Schedule C less 1/2 of the self-employment tax. And they only make employee contributions. So they want to keep their self-employment income as low as possible. So in that case, remember, they've got to run that pre-calculation. So now the question becomes, okay, what income would need to be reported on line 31 of Schedule C? Well, if they're under 50, and we're talking about making contributions for 2025, if they have $25,287 of net self-employment income reported on line 31 of Schedule C, after they reduce that amount by 1/2 of self-employment tax, their self-employment compensation is going to be equal to $23,500. So they're going to be able to contribute 100% of that amount, right, as an employee contribution to a solo 401k, right? We're assuming that they're not making contributions to a day job plan. So it's not reduced by contributions made to another plan. They can contribute the entire amount, either as a pre-tax or a Roth, to the solo 401k. Now let's assume that the person is age 50 or older, right? In that case, they would need $33,357 of net income reported on line 31 of Schedule C. After they reduce that amount by 1/2 of the self-employment tax, self-employment compensation is then going to be equal to $31,000. And again, they're going to be able to contribute 100% of that amount, all their compensation, to the solo 401k, either as a pre-tax or a Roth employee contribution. And then lastly, now with the super catch-up contribution, you've got someone that's age 60 to 63. As long as they have $37,392 of net income reported on line 31 of Schedule C, after they reduce that amount by 1/2 of self-employment tax, that's going to give them $34,750, which then they can contribute 100% of that, all of that, either as a pre-tax or a Roth employee contribution. So now let's go to scenario 2, which is a slight variation of scenario 1. Scenario 1, we were trying to keep self-employment income as low as possible. Now we're just trying to keep it low, right? So the difference here is that now we want to make both employee and employer contributions to the solo 401k. Same otherwise scenario, right? Business tax as a sole proprietorship. One participant doesn't make contributions to another plan like a day job plan, but their goal is to contribute all their self-employment compensation to the solo 401k, but they want to not just fill up the employee bucket, they also want to fill up the employer bucket. So how much income would they need? So if that person's under 50 years of age, in order to have self-employment compensation where they could contribute 100% as an employee plus 20%, or excuse me, they can make an employee contribution up to $23,500 and then 20% of that amount as an employer. And together, those two contributions would be equal to 100% of their self-employment compensation. They would need to have $31,607 of net self-employment income on line 31 of Schedule C. Once they reduce that amount by 1/2 of self-employment tax, that's going to give them $29,374. So 20% of that amount would be able to be contributed as an employer contribution. That's equal to $5,874, which would leave them with $23,500 that they can contribute as an employee contribution. So now they're still contributing 100% of their income, but they're filling up both the employee and the employer bucket. Now let's assume that the person is age 50 or older. If that individual had $41,696 of self-employment income, right, net income reported on line 31 of Schedule C, they would first reduce that amount by 1/2 of self-employment tax. That would give them $38,750. 20% of that amount would be $7,750. And they could still contribute the rest, another $31,000, between the $23,500 plus the $7,500 catch-up as an employee contribution. So just like the first scenario, they're going to be able to fill up the entire employee bucket as well as the entire employer bucket. And that's going to be equal to 100% of their self-employment compensation. Last version of this scenario is the person that's age 60 to 63. If that person has $46,739 as net self-employment income on line 31 of Schedule C, and then reduces that amount by 1/2 of the self-employment tax, that would be equal to $43,437, right? 20% of that amount would be $8,687. So that can go into that employer bucket, leaving them another $34,750 because they're age 60 to 63 and they're now able to make the super catch-up contribution, which they can contribute 100% of that amount as an employee contribution. So same result. Person's able to fill up both the employee and the employer buckets, and that uses all their self-employment compensation. So they're able to maximize their solo 401k contributions while keeping their self-employment income low. So they've got two more scenarios, right? Maximizing solo 401k contributions means different things to different people. So some individuals, when they talk about maximizing their solo 401k contributions, they go to maximizing the pre-tax solo 401k contributions. They want to maximize the income tax reduction benefit now for the year for which the contribution is made. So again, let's assume the individual's business is taxed as a sole proprietorship, 1099 independent contractor, single member LLC, does not make contributions to another plan like a day job plan. So if that person has $246,722 of line 31 Schedule C net income, and then reduces that by 1/2 of self-employment tax, their self-employment compensation is going to be equal to $232,500, which means they're going to be able to make an employer contribution of $46,500, right? 20% of their self-employment compensation. And regardless of their age, they're going to be able to make additional employee contributions up to the applicable limits. $23,500 if they're under age 50, $31,000 if they're age 50 or older, or $34,750 if they're age 60 to 63. So finally, last scenario, and then we'll turn to the good questions. Thanks for your patience. We wanted to finish the thoughts here on this presentation. Is I want to maximize my solo 401k contributions, but when I say maximize solo 401k contributions, I'm referring to maximizing the Roth contributions. So in that scenario, what's my magic number? How much income do I need? In my business is taxed as a sole proprietorship. It's a one participant plan. I don't make contributions to another plan like a day job plan. My goal is to maximize Roth and or voluntary after-tax contributions. So that voluntary after-tax contribution limit is 100% of self-employment compensation, dollar for dollar, up to the overall limit. So for someone that's under age 50, they need self-employment compensation equal to $70,000. Excuse me. So they would need $75,322 reported on line 31 of Schedule C, less 1/2 of self-employment tax. That would give them $70,000 of self-employment compensation. They would then be able to contribute $23,500 as a Roth employee contribution, and the difference up to $70,000, another $46,500 as a voluntary after-tax contribution, and then move that over to the Roth account. If that person was age 50 or older, they would need $77,500 of self-employment compensation, which means they would need to report $83,392 on line 31 as Schedule C, less one half of the self-employment tax is equal to $77,500. They would then be able to contribute $31,000 as a Roth employee contribution. You have the $23,500 standard employee contribution limit, plus an additional $7,500 as a catch-up contribution. And then they could contribute the difference up to $77,500 as a voluntary after-tax contribution. So another $46,500, which then they could move over to the Roth. At the end of the day, that individual would have $77,500 in their Roth solo 401k. Finally, the individual that's age 60 to 63, that individual would need $81,250 as self-employment compensation, which means they would need to report $87,427 on line 31 as Schedule C, less one half of the self-employment tax would give them $81,250. They could contribute then $34,750 as a Roth employee contribution. They'd have the standard $23,500 plus now the super catch-up contribution of $11,250 for a total of $34,750 that would be deposited directly to the Roth Solo 401k account. And then they could contribute the difference up to $81,250, another $46,500 as a voluntary after-tax contribution, then move that over to the Roth Solo 401k. So at the end of the day, that individual would have $81,250 in their Roth Solo 401k account. Okay, wonderful. All right, so we really appreciate the chance to discuss these topics. I want to go now to the questions. Thank you so much for bringing the questions. We love the opportunity to discuss these topics, so we really appreciate you bringing the questions. So let's jump into it. And as always, if you found this to be helpful, if you could please like on YouTube, it helps us get the word out, or like on the other platforms like LinkedIn or Twitter, to help us get the word out to other entrepreneurs like you, right? To get this good information out to them. So we appreciate the chance again to discuss. So now let's turn to the questions. Thank you for your patience. Thank you for bringing the questions. I have several LLC partnerships and several Schedule C businesses, which produce income used to determine my contributions amount. So doesn't it make sense for me to use line 2 of Schedule SC, which is both the net profit or loss from combined Schedule C's, line 31, and Schedule K1, Form 1065s, for making my business income calculations for our contributions to the solo 401k? So thank you so much. So first of all, it's certainly not uncommon that our customers will be serial entrepreneurs and have multiple streams of self-employment income. And as long as there are no full-time non-owner, non-spouse employees working for any business owned by that individual or a spouse, if any, they would be able to set up a solo 401k and then aggregate from all sources of self-employment income to justify contributions to the solo 401k. Now, for purposes of determining how much they can contribute, they have, for a business, is taxed as a sole proprietorship. So income from a Schedule C, as you noted, or income from a partnership. You got to run that pre-calculation where you take, for example, line 31 of Schedule C, less one half of the self-employment tax, or line 14 of the K1 from the partnership, less one half of self-employment tax. And one would need to use the self-employment tax that they would have to pay regardless of whether they had income, say, from a W-2 job. So the prudent choice, the prudent course would be to use the self-employment income, for example, that we generate with our calculator. You can find it easily at mysolo401k.net. If you go left to right, there's a menu, Home, About, Solo 401k. Under Learn, and then Online Tools, you can easily find the calculator. So that would be the best choice, is to use that self-employment income to then determine what self-employment compensation is. Because otherwise the risk is that you end up in an excess contribution scenario, because you're not going to reduce the net income by enough self-employment, by enough one half of self-employment tax. Hopefully that makes sense. Or by enough of the amount that's equal to one half of self-employment tax. So if you underestimate your self-employment tax, then that could end up in the risk of that is that you end up with too high of self-employment, or you end up thinking that you have more self-employment compensation than you actually have, and then end up over contributing to the plan. Hopefully that makes sense. Hopefully that helps. Thank you for bringing the good question. All right, next question. I understand the question is about purchasing life insurance. We've got a good post on our website that talks about, I'm going to try to pull that up, that talks about the ability to purchase life insurance or invest in life insurance using a solo 401k. But it sounds like what you're describing would be to use that as collateral to obtain a loan. And you cannot use the solo 401k assets as collateral to obtain a loan. So it is possible to borrow from the solo 401k, but that would just be a straightforward taking money out of the solo 401k account, cash out of the solo 401k account, documenting that as a loan, paying it back according to the schedule. And I just chatted over a link to the page on our website that talks about investing in life insurance. Hopefully that helps. I have a single member LLC and income on a 1099 NEC. My spouse has a W-2 job and contributes to her employer plan. We file taxes as married jointly. Can I make use of solo 401k? So as long as there are no employees working for your business, right? The fact that your spouse herself has a W-2 job won't prevent the other spouse who is separately self-employed and there's no employees working for any business owned by either spouse. For that other self-employed spouse, it won't stop that other self-employed spouse from setting up a solo 401k. Hopefully that helps. Well, thank you so much for the good questions. Thank you so much for the great participation. Again, if you found this to be helpful, please like, please subscribe. It helps us to get the word out to other entrepreneurs like you. Please continue to engage. We'll be back next week with more content, more live sessions. Again, if you subscribe, you get notifications of when we go live and you can jump on and ask questions. Looks like it might be taking us to the end for today. All right, everyone, take care. Have a good one.